Welcome to the deep dive. Today, we're venturing into, well, a pretty complex area, stock market manipulation and fraud, specifically looking at the situation here in Thailand.
Yeah, and we're drawing heavily on the insights of Dr. Niyat Hembakura. He's, a real pioneer of value investing in Thailand, very well respected.
Exactly. Our main source is a really interesting YouTube interview he did on the Tone Kumkot Ferry Tem IG channel. We're going to zero in on the strategies of deception, what he calls hotek.
Oh, okay. Which is
Go ahead.
basically Thai for cheating or fraud.
Right. And our mission for you listening in is pretty clear. We want to help equip you with the knowledge to spot these tactics and hopefully steer clear of them.
And learning from Dr. Niyat's experience, his long-term perspective is invaluable for that, I think.
Definitely. Okay, so let's start at the beginning. Why does this kind of rumor even happen? Dr. Newitt has a pretty direct take on it.
Well, yeah, he suggests it's almost ingrained, tied to this perception of, like, high potential reward versus what seems like low risk.
Low risk of getting caught, you mean?
Getting caught, yeah, and maybe even low penalties if you do get caught. That imbalance is key.
And while, cheating happens in lots of areas, not just finance,
Sure, everywhere.
Dr. Newitt stresses that the sheer amount of money sloshing around the stock market just amplifies everything. The stakes are so much higher.
Absolutely. And it often hits the small individual investors the hardest. They maybe don't always have the deep understanding of how these schemes work.
Right. And this is where it gets particularly, well, striking. Dr. Newitt talks about this surprisingly low perceived risk for perpetrators in Thailand.
He mentions the legal system maybe being a bit slow
Uh,
and the penalties seeming, well, less severe compared to other places.
he even brought up Vietnam, where, major financial fraud could potentially lead to the death penalty. It's a stark contrast.
It really is. And it makes you think about deterrence, doesn't it? If the consequences aren't seen as that bad.
Then the incentive to cheat might feel stronger.
Yeah.
Okay, now let's factor in the digital age. Technology's changed everything, and it seems like it's also opened up new doors for
Oh, definitely. The internet, digital platforms, they allow fraud on a scale and speed that was just, unimaginable before.
reaching thousands, maybe tens of thousands, with just a few clicks.
Exactly. Spreading misleading info, luring people in.
Yeah.
It's become incredibly efficient,
And Dr. Newitt notes that even if reporting of this stuff is maybe going up,
which it might be.
the actual effective prosecution, that still seems to be a challenge. It's lagging behind.
Yeah, he uses this analogy, which I thought was quite good. Like you order a sleep aid online, pay your money, and what arrives? An empty liquor bottle.
Huh. Okay, I see the connection.
It's the same kind of deception, right?
Yeah.
False promises, hyped up claims,
Yeah.
just like some stocks promising sky-high returns that aren't real.
That leads nicely into another analogy he uses, transforming a frog into a prince? What's going on there?
Okay, so this is about taking, let's say, a pretty mediocre, uninteresting company while it's still private.
Right, a bit of a frog.
Yeah, exactly. Then, when it goes public, they give it this massive makeover. Spin a fantastic story, make it sound incredibly desirable, like a prince.
Ah, okay. So it's all about the narrative, the hype.
Precisely. And then the insiders, who got in early when it was still a frog, they sell their shares into that hype for a huge profit.
Leaving the later investors holding, well, the frog again, once the hype dies down.
Pretty much, the underlying value never really changed. It comes back to that core idea Dr. Noah keeps mentioning. High potential reward, low perceived risk for the manipulators.
And he actually said, didn't he, that he struggles to recall anyone actually going to prison for stock market fraud in Thailand. That's quite a statement.
It is quite stark, yeah.
But it's not just the maybe less experienced investors who fall for this. He points out that even sophisticated value investors, the VIs, they can get caught too.
Yeah, that's an important point. Even people who focus really hard on fundamentals can get sucked in by a really well-crafted story, especially if it kind of fits what they're looking for,
Like it confirms their own analysis almost.
Exactly. Which brings us to this tactic called Tanniga Kankin cornering shares. Can you walk us through that?
Sure. So this is where a group, or maybe even an individual, starts buying up a huge chunk of a company's freely traded shares.
Okay, accumulating a big position.
Right. Enough to basically control the supply and artificially push the price up. But they don't just do that.
There's more to it.
Yeah, they simultaneously weave this really compelling, a story about the company's amazing future prospects, new contracts, amazing tech, whatever fits.
Okay, so the rising price seems justified by this great story.
Exactly. So other investors, maybe even in institutions or VIs, see the price going up, they hear the story, it seems to confirm the trend, and they start buying in too.
Following the momentum.
Right. But eventually, the cornerers, having pushed the price way beyond its real value, they start selling. The corner, then umfil. It breaks,
And the price collapses.
leaving anyone who bought in late with massive losses. Because the story, well, it wasn't built on solid ground.
It was built on manipulation. Yeah, makes sense.
And Dr. Nguyen says cornering is just one trick. There are loads of other ways this had happened.
Oh, it gets really diverse. Tailored to the specific company, the industry, investor psychology, you name it. He mentioned con-siphoning funds.
Siphoning, how does that work?
Basically, finding ways to secretly extract money out of the company for personal gain. It might not even show up in the stock price immediately, but it drains the company's value over time.
Sneaky. And then there are even more complex schemes, like targeting brokers.
Yeah, he touched on that, like selling shares where the supposed buyer is fake, leaving the broker on the hook to pay, and then the impersonation scams.
Yeah.
That seems really prevalent now.
Oh, right. People pretending to be him online.
Exactly.
Yeah.
Fakes, setting up social media profiles, messaging people, claiming to be Dr. Noed, offering amazing investment advice.
Wow.
They lure people into sending money for, say, fake overseas investments, sometimes with completely fabricated trading platforms. Then, when the victim tries to withdraw their supposed profits,
Let me guess, they ask for fees.
you got it. Fees to release the money, which of course never comes. And because these often operate across borders, prosecuting them is incredibly difficult.
Man, that's rough. Okay, let's shift to how companies themselves can be made to look better than they are, manipulating the perception of financial health.
Right. It's all about making the company look attractive to investors. Dr. Nguyen talks about kind of essentially dressing up the financial statement.
Like putting makeup on the numbers.
Kind of, yeah. Using various accounting tricks, maybe involving offshore subsidiaries to make things harder to track.
So what kind of tricks could they, like, inflate revenues?
Maybe selling goods to related parties, basically selling to themselves at inflated prices. Or they could try to make profit margins look better.
How?
Maybe by, say, buying raw materials through one related company at a high price, then selling the finished product through another related company at a lower price, making the core company's margins look artificially high in between.
Wow, that's intricate. And the goal is to make the valuation look good.
Exactly. Particularly the price to earnings, the PE ratio. If you artificially inflate the earnings, the PE ratio goes down, making the stock look cheaper, more attractive.
Deceptively attractive. Okay, this all sounds quite dangerous for investors. But thankfully, Dr. Nguyen also offers advice on how to avoid these traps. What are his key principles?
Well, the big one, maybe the simplest but most important, is just healthy skepticism. If something looks too good to be true.
It probably is.
It probably is, yeah. He really hammers home the need to analyze the actual underlying business, understand its fundamentals, question things like unusually high profit margins, especially in really competitive industries.
Doesn't make sense.
Good point.
What else?
Understand that reward versus risk balance. He warns against chasing overpriced stocks, those with super high PE ratios. Even if the growth story sounds amazing, the potential downside, the risk of loss, might just be way too high compared to any realistic potential gain.
So avoid stocks driven purely by hype and hope?
Pretty much, yeah. If there aren't solid fundamentals underneath, be very wary. Interestingly, he mentions he personally avoids almost all IPO's initial public offerings.
Really? Why's that?
He generally feels they tend to be overpriced at the start.
Yeah.
The sellers are trying to get the best possible price, obviously. He even said he's turned down chances for what looked like guaranteed short-term IPO gains because it goes against his principles.
Sticking to his guns.
Right. He's quick to say not all IPOs are scams, of course.
Right.
But, the promoter's main goal is often just to sell the shares, regardless of the company's actual long-term viability.
So having a firm set of your own principles is crucial protection.
Absolutely. It stops you getting swayed by tempting offers that might actually be traps. And linked to that is looking really closely at management behavior.
Okay. What should you look for there? Red flags.
Definitely. Be cautious if management seems overly boastful, constantly spinning these huge hyped-up stories.
Actions speak louder than words.
Exactly. Watch what they do. Are they frequently buying and selling large amounts of their own company stock? Are they issuing lots of warrants, which can dilute existing shareholders? Are there questionable deals happening with related parties? Is the company taking on excessive debt? frequently raising more capital from the market, maybe for ventures that seem outside their core business, or in markets that already look saturated. He also gets suspicious about heavy asset companies with flat stock prices suddenly making huge, unexplained investments.
Like, where's the money really going?
Yeah, could it be a way to mask siphoning funds? Investing in tons of projects at once can sometimes obscure where the money is actually ending up.
Okay, and beyond management behavior, what about red flags in the company's actual business activities?
Yeah, look out for unusual or illogical transactions, especially with related parties. Why are they doing that deal? Does it make sense for the core business?
Right.
Is the company lending money out in strange ways that don't fit its normal operations? Are they buying assets that don't seem necessary or paying way too much for them? Basically, is there a clear, logical rationale for their major decisions?
And if there isn't,
If there isn't, you should be asking why. Of course, he admits, if fraud is really well hidden, deep within the operations and not obvious in the financials, it can be incredibly hard to spot.
yeah, that's the scary part. Are there particular sectors or types of businesses that maybe attract more of this core activity?
He suggests keeping an eye on the hot sectors, whatever's trendy, and getting a lot of buzz.
Because that's where eager investors flock.
Exactly. They're more susceptible to hype. He specifically mentions new economy companies, maybe those with short track records that are growing really fast, often through lots of acquisitions.
High growth can hide problems.
It can, and also the failure rate in these fast-growing disruptive sectors is often quite high anyway. So you need to do extra homework, look beyond just the management's rosy forecasts.
He also brings in wisdom from other investing giants, right? Like Buffett and Munger.
He does. He mentions Warren Buffett's point about integrity being the absolute most important quality. Intelligence and energy are great, but without integrity, they can actually be dangerous in management.
Makes sense. If someone's smart and driven but dishonest, look out.
Right. And he also brings up Charlie Munger's advice, which is basically, know what causes harm and avoid it. Apply that to investing, avoid stocks that look inherently risky, or management teams that seem questionable. Steer clear of likely trouble.
So pulling it all together, what's Dr. Nguyen's final piece of advice for, the average person trying to invest safely?
Well, first, he circles back to greed, often being the root cause of goodness. On the flip side, investors need to manage their own greed, too.
And recognize the complexity.
Yes, acknowledge that business and markets are complex. For many people, maybe the best path is simply to avoid the really high-risk stuff altogether.
Focus on what kinds of companies, then?
Focus on established, reputable companies. Ones with transparent operations, a solid track record, hopefully a history of steady, understandable growth.
Maybe the long game.
Absolutely. He emphasizes the power of compounding returns over time. And patience is key. The stock market isn't a get-rich-quick machine.
And if you're impatient.
You're much more likely to get taken advantage of. Impatience makes you vulnerable.
So really, Dr. Nguyen gives us a crucial look into this darker side of the market, highlighting these deceptive tactics.
Yeah, and it all underscores how vital it is to be an informed, intelligent, and I'd say skeptical investor.
Definitely. So as you navigate your own investment path, keep these insights in mind. That temptation for quick, easy gains can be strong, right?
Oh yeah, very strong.
But focusing on understanding the real business, questioning those too good to be true stories, and really prioritizing ethical, transparent management, those are probably your best defenses.
Couldn't agree more. And maybe a final thought for you to consider. Thinking about all this, what concrete steps will you take starting now to really cultivate that critical, discerning mindset in your own approach to investing?